Hello, everybody. It's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And of course, many of you know me as Mr. Valuation. And this video was inspired by a subscriber, and I hope I pronounce his name correctly, John Renaud, and it ends in a D, so it could be Renaud. So I apologize, John, if I'm mispronouncing it. But John posed this question. He asked me, Chuck, with a fragile market resembling a crystal goblet walking a tightrope on a windy day, that was very well said, have you ever considered doing a video on exiting stocks? What would you take into consideration? Short gain versus long, ex-dividend dates, partial sells, etc. Yes, it would be going against the grain, but just as important, an exit strategy for boomers like me. And you know, this is the most commonly asked question I get. Now, I responded to John because this was actually a couple of days ago, so I lied a little bit, but I meant to say my next video. But I said, John, coincidentally, I will be doing a video on the subject tomorrow because I actually had planned on doing a when to sell video because it's one of the most common questions that investors ask. And then there was another gentleman, Ed Jordan. Thanks, Ed, for having a simple name to pronounce. He said, FastGraphs good because you got me all scared on Apple and I feel like I need to get out, but it's Apple. Unfortunately, I bought it in February before finding this channel. I'm up barely, but that graph view makes me nervous, not like the warm blanket feeling my AbbVie graph gives me. Now, the reason I also shared John's comment with you is because it really brings into a very important distinction, and that is that, if there's a difference between a sell decision and a buy decision, and I think that gets mistaken quite often. So let's go ahead and move into our FastGraphs tool, and let's start looking at some examples where I can help you maybe answer this question. Number one is that when I show stocks like Apple, and Apple's one that I've talked about many times, and I always get issues when concerns and criticisms when I show Apple because Apple's one of the most beloved stocks on the planet. And by the way, I'm using the new version of FastGraphs just to give those of you who are subscribers some insights into the fact that we are making progress. The basic FastGraph is almost fully done and working properly. We still have some bugs on some of the other parts, but we're moving very rapidly now. Fortunately, all of our developers are healthy again and vigorously back to trying to get this thing launched as quickly as possible. But regardless, this is Apple. And here's the point. Now, Ed Jordan claimed that he bought Apple in February. So I'm going to, this is January 29th. And he said he's up barely. So I'm assuming that's, somewhere in this neighborhood is where John made his Apple purchase. He bought it when it was high, and it's up a little higher since he bought it, but it also went down since he bought it. And that's the nature of the beast. But the point is this is a terrific company. And you could have bought this stock over many, many years, and it would have been a forever stock. And I'm going to try to make that a little clear here in a moment. The point is, though, this would have been not a time to buy Apple. Now, the question is it a time to sell Apple? Even if had you bought it back here when it was very inexpensive, the question would still be, should you sell Apple now? And, technically speaking, that could be true. But I'm going to go over some reasons and some discussions about buying and selling here to try to put this when to sell decision into perspective. First of all, people have quoted Warren Buffett quite often. One of his favorite statements are, the best time to sell a stock is never. And he talks about owning forever stocks. All right. And, theoretically, I believe that's what we as investors should be doing. It's what I strive to do. Before I ever buy a stock, and by the way, let me back up a step. I call this business perspective investing. I'm really interested in investing in great businesses. I don't care very much about trading the stock market because I find it too fickle, too erratic, too unpredictable to try to chase stock prices and worry about stock prices. What I try to do is invest in companies that I believe have long-term bright futures that I literally or theoretically can own forever. So a forever stock is one that you would buy and hold for very long. That's your intention, is to buy it and hold it for a very long time. Now, there might be some reasons why you would sell those. Massive overvaluation would be one of them. And I even use the phraseology quite often, dangerous overvaluation. But you can look at that in a couple of different ways as well. And I'm going to show you some examples of that here in a moment where, you can be technically right and yet practically speaking, it's very hard to make these buy and sell decisions. But regardless, if you buy a really great company, then perhaps the best time to sell is never. You want to hold on to the business for as long as you can, because ultimately that's where you're going to make the most money. And, I have a theory that says every time you make a decision on when to buy or sell, you expose yourself to making a mistake. And the more decisions you make, the more potential mistakes you can make. And by the way, probably people make more mistakes than they do make good decisions. But the point is, if you really strive to find the right company, you can often hold those companies literally for your entire lifetime and do quite well. And I'll show you some good examples of that. But the other side of that is you also have to have a practical side to this too. One of the stocks that was really considered a forever stock for many, many years was General Electric. This was a terrific company. And I'm going to bring this out to max because I want you to really get the perspective. There was a time, and I can only go back about 6 or 7 years here, where General Electric stock chart looked just like this. And I'm going to go ahead and scroll back here. Its earnings increased year after year after year after year, and it did that for a very long time. And everybody, General Electric was one of those, iconic names that you just bought and sold forever. But this brings me to the point that there is a valid reason, and I'm going to show you some real life examples of this here, even in more detail in a moment. But once fundamentals deteriorate, that's an argument that stocks could be sold. That's one reason. If you look at the fundamental deterioration here, even if you'd have held on, to General Electric all the way into where fundamentals deteriorated here, you could have still gotten out of the stock and saved yourself for money. You would have definitely lost money. If you were clairvoyant enough, you were doing enough research where you could, sell the stock when it was, just before the fundamentals deteriorated or as they were showing the first signs deteriorating, you could have saved yourself a lot of, heartache and capital loss on a company like General Electric. But the point is this: one of the primary reasons for selling a stock would be if fundamentals deteriorate. Now, let me go ahead and show you some real good examples of that, because I believe this is a very important part of the process. So I'm going to start out here with PG&E Company. And, this company's business collapsed. I don't really know a lot about this stock, so I don't know why it collapsed. But you can see the price, tracked earnings. The fundamentals collapsed. You could have sold it here even for up to a year afterwards. And again, saved yourself an awful lot of heartache. So let me give you some other examples. Look at Devon Energy here. I'm using GAAP earnings. I'm going to go ahead and go into operating earnings, because here you see the operation of this business failed. So anywhere, once these fundamentals really started looking bad, you could have got out of the stock. You could have even got out of the stock as late as 2015 and, probably lost money again, but still saved yourself a lot of grief. This is not a forever stock. This company's fundamentals were deteriorating. We all probably know why. It obviously is an oil and gas exploration company, which are risky in the first place. But the point is, one good reason to get out of a stock when fundamentals are deteriorating. So let's look at a couple of more examples here. Let's look at Fluorocorp. And here's another case where you started to see fundamentals deteriorate. Now, if you could have bought this stock anywhere back in here, and I'll try to be generous here. I'll try to buy it when the valuation was really low. And you could have probably, you could have sold it. The fundamentals now deteriorated for 2 years. You actually got opportunities to sell. Now, I'm going to pick the worst time to sell it in here. And you'd have kind of broken even and made a little bit of money before you'd have seen the stock go on to go ahead and lose another, 40-some% of your money. So when fundamentals are deteriorating, this is not my idea of a forever stock. You don't buy a stock like this and plan to hold on for forever. Now, Mosaic is a fertilizer and agricultural commodity-based stock, if you will, chemicals. And you can see there was a period of time when the growth was very strong and the stock was very strong. Now, this would have been a massive overvaluation, because even if I was looking at this level of earnings growth, I would have argued it really didn't justify. But that might have been harder to see in current sight than it would have been in hindsight, because you had these very strong growth rates going on here. I do want you to notice that at the bottom of the chart. So it could have been easy to argue that these high PEs made some sense. But, you're looking at price earnings ratios here turned out to be, only 30 times earnings, because earnings changed quite a bit. But the reality of it is it was very expensive. But if you notice how fundamentals began deteriorating here, and you can see that the stock price tracked that. So this is not a forever stock. What I'm really trying to suggest here, stocks like this probably should have never been owned in the first place. And we all know the story of Sears. And look here, even if you'd have held on to Sears and, got lucky and finally decided to sell it somewhere in here before the fundamentals completely disappeared, you could have still saved yourself an awful lot of money by not continuing to hold on to the stock. So there are valid reasons for selling a stock, and one of them would be when the fundamentals actually deteriorate. But now there are other reasons to argue to hold a stock forever. And I'm going to use a stock like Starbucks here because this is where it gets tricky. All right, Starbucks has a great growth record. If it wasn't for COVID, you probably wouldn't have seen this dip in earnings right here. So I do want to make that clear. But this stock has been perennially expensive. But one thing about it, this has been a very consistent, very strong grower. Even if I go pre-COVID here, which will kind of help you see what my point is, and look at this. This is a company that grew earnings at 20% a year. So that kind of growth is very strong. But now here's where making the right sell decision gets a little bit tricky, ladies and gentlemen. Technically speaking, I would have argued that once you saw PEs above 50 up here, that might have made sense for you to sell the stock, okay? Before you would have suffered, what turned out to be a 75% drop in value from June of 2006 through June of 2009. But let's go back and say you bought this company when it was reasonably priced, or even back here when it was still a little bit expensive, back in the early years of it starting out as a business, back in October of 2000, and held it through the first recession and held it all the way through the second recession. Even then, you wouldn't have made a great deal of money. You would have only made about 3% a year because we did have a drop in earnings and you overpaid for the stock. But let's look at it a different way. Let's buy the stock when it was more reasonably priced back here, and let's hold it until it gets into this peak of, I'm just picking dates here. I'm not trying to be real precise. So I went from 2001 to 2006 here, and I turned 10,000 into 41,000 and made about a 36.5% annualized rate of return. And you can see Starbucks was growing earnings probably pretty close to averaging that number there. This was, pretty good growth, but the stock had gotten expensive. Now, I want to remember this October 31st, 2001 number, because had I sold it, I turned 10,000 into 41,000. If I'd have bought it as it came out of the Great Recession, if I'd have went ahead and sold it and then, bought the stock back when the price was $5.50, if I'd have kept that money in cash, I used to joke all the time as a money manager, I do want to hold these stocks forever, and Starbucks would have been an example of that. But what I might do is I might sell it and put it in cash if I felt the overvaluation was extreme. And I used to argue, I wish I could put on my report, clients, this is my Starbucks. This cash is really what I've allocating to Starbucks, and then waited until valuation came somewhere back into alignment, not necessarily a perfect bottom because I'm not that smart, and then bought the stock back. You could end up making a great deal more money in the long run because you could buy a lot more stock here at $5.55 a share. And I don't remember exactly where I was here, but this will be close enough, than you could when the stock was $18 or $19 a share. All right. So, or, we'll call it $18 a share. So I could buy almost, more than 3 times as many shares that I sold up here at 18 at 5 and then ride this next leg of the thing up. But here's another point that I want to make. Had I bought the stock on May of 01 and I held it all the way through, ignoring all of these ups and downs, and held it all the way through yesterday's closing stock price. So if I bought it in May of 2001 and held it all the way through yesterday's close, I'd have made 18% a year. Okay, so that's a pretty strong rate of return. Turned $10,000 into $260,000 over that time frame. Absolutely awesome. And that's the benefit of buying and holding the stock for the long run. Now, it takes a lot of courage to watch a stock drop 75% during a 3-year period, before you held on to it. But as long as the company continued to grow, and by the way, it did suffer a little bit during the recession. Earnings growth did fall 18%, but it still was very, very profitable. In fact, it was probably the 3rd most profitable year in the company's history. So the company wasn't really bleeding red ink here and going out of business. And so it might have made sense to sell it. But the point is, if you were smart enough and had good enough timing to do that, as I pointed out earlier, you could have made a great deal of money. But on the other hand, Starbucks is probably one of those forever stocks you can buy and just hold forever. Another example that I've talked about here in recent times, which would be Amazon. Now with Amazon, it's very difficult to look at this company from a standpoint of operating earnings because it didn't make any money, often. It actually lost money quite often in its early years. So what I've always talked about when I'm looking at Amazon, I want you to understand that that's one of the advantages of this research tool here is let's look at it from a standpoint of operating cash flow. Amazon is traded at around 25 to 30 times operating cash flow, and you would have made a great deal of money, and there was no reason to sell the stock. And it might have got, a little bit overvalued here based on cash flow, but there was just never any compelling reason to want to sell Amazon during this whole time frame. And based on expectations of future growth, everything still looks pretty good going forward. So, this is what I mean. You don't really want to buy it. I think the optimum thing to do is to buy these stocks when they're reasonably priced. I'm just picking some times here and holding it. And here you're making 35% a year owning Amazon, and it's just been a phenomenal business. And if you did your homework correctly with looking at it cash flows, you really never had any reason to sell Amazon. Okay, let me go and show you another example that's less growthy and more what I would call a traditional stock. We'll talk about 3M Corporation here. And here I'm looking at 3M also based on operating cash flow, which is a really good way for me to look at it here because what I want you to note is the price tracks cash flows. Now, obviously, a great recession is a period of pessimism. The stock got very, very inexpensive. What a great time to buy it. Okay, it's never been massively overvalued, but it was, pretty expensive even back here at 17 times cash flow when the normal price to cash flow is about 14 or 15. But that would have hurt you. That would have given you a very low rate of return over a long period of time. On the other hand, buy it when it's trading pretty much in line with its cash flows. And, even, just going back to where it's trading at fair value, you're making 7.5% or 8%, which is what you can expect from a 7% grower. Okay. Now, 3M did get very expensive on an operating cash flow. It would have made sense to sell the stock there. I do believe that would be a time. So significant overvaluation is another reason. But I want you to be careful. That reason existed for all of this time. So what I like to do is rather than just knee-jerk react and sell, I like to put stocks on a sell watch list. And then if I start to see a real deterioration, if I start to see any weakness, then I might make the decision. But the point is there's judgment involved. But here's the key point that I don't want you to miss. If you screw up and make a mistake with a really good business, a forever stock, a stock that you can own forever, you're going to probably end up being okay as long as you stay in it after that point in time. Now, there's a lot of woulda, coulda, shouldas. Like could have sold it up here and woulda, coulda bought it back down here and even made more money, just like I did with the Starbucks example. But the point is, it really makes sense not to be knee-jerk. And I do believe a portfolio is like a bar of soap. The more you handle it, the smaller it gets. So the sell decision is difficult. And again, you also got to be careful because there's a lot of ways to look at stocks. Like, let me give you an example of one that I think is real important. Now, before I do that, I'm going to go back to operating earnings here, which is the metric that I really like the best. And I think it really gives you some, I wouldn't have bought 3M here at this high multiple of earnings where I showed you cash, so it looked a little better earlier. And I would have, felt that, when we get up here to PE of 27 or 8, when a 15 PE is, fair value. Now, the market does like to value this at a premium, but that's only because I'm drawing this line. But here's how I want you to use this blue line, because people ask me this question all the time. I'm analyzing with that line. That's a 20 PE. Just because the number says it's 20 times earnings is a normal PE, that doesn't mean, first of all, that that's accurate or perfect, because I can look at all these years here and the stock never traded at 20, and I can look at these years here and it traded above 20, and these years here it traded above 20. But even more importantly, if I draw the graph at different levels, this normal PE level changes quite a bit because it's based on how the market has valued the stock over whatever time frame you're looking at. So I would have trusted the orange line here in this example more than I would have the blue line. So these were very clear opportunities of the stock being overpriced based on earnings. But let me look at another one of the more favorite stocks out here on the planet, one that's done extremely well, and that's Visa. Okay, now this is a real tough one, and I've written articles about this, and I actually did sell Visa. I bought Visa back in here when it was extremely inexpensive, and I sold Visa somewhere, I think it was in 2019, even before COVID, probably 2018 or I don't remember the exact numbers. I can look them up for you. But I made a great deal of money. I did average about 30% a year owning my Visa. And of course, the stock has continued to go up. All right. But I made a decision because I had other places to put the money. And I want to make that really clear here in a moment and show you an example of what I'm talking about. There were places where I could have invested the money and made better returns. But I also want you to see how tricky and difficult this is by looking at Visa from a standpoint of operating cash flows. Visa, has traded at around 29. Now that's expensive. 29 times cash flow, 28 to 29 times cash flow is not cheap. And now at 40 times cash flow, that's clear indicator that it's overvalued, but cash flows are expected to grow dramatically. So, if this was correct and I just held on to the stock, I would stand to make a double-digit rate of return going forward. So I don't know that Visa requires being sold. The difference would be I would be less inclined to buy Visa here than I would have been inclined to buy it when it was trading at more reasonable valuations here. Because I think the key is, and I've said this over and over again, you really make your money on the buy side. So you don't want to overpay for even the best stocks out there. All right, but the sell decision is a lot trickier. Now, it also invests, it depends on what kind of company. If you're dealing with some of these shakier companies like I, showed you a few moments ago, you don't want to hold on to these, very long if you start seeing fundamentals deteriorate. These are just not the kinds of companies that are forever stocks. They're very cyclical, very erratic. So if you're buying those kind of stocks, the wholesale discussion is totally different than if you're buying Nike, Disney, McDonald's, Church and Dwight, these really high quality companies. Now, there are points where it might make sense to sell them when they get very expensive, but here's how I want to end this video. Generally speaking, if you buy the stocks right, if you buy these great businesses when they're inexpensive, the odds are the best time to sell them is never. Okay? You want to hold on to them as long as you can. Now, if they're dividend paying stocks, the whole process even gets easier if you keep getting a growing income stream and you're happy. One of the stocks that Warren Buffett has often talked about never selling is Coca-Cola. And I've not necessarily agreed with Warren Buffett on this because I'm going to look at Coca-Cola from a cash flow. I want to look at it in the best light I can. It's not a great grower. I can change some time frames here. And, if you'd have bought it when it was attractively valued back here in January of 2006, and held it to yesterday's close, you'd have made 8.5%. The dividend growth was very, very strong. You could have seen the dividend increased year after year here. So this, there was really no reason to sell Coca-Cola at this time because it's a very stable, A+ rated company, that generates a lot of cash flow. And, you could really be a long-term owner of that, looking at it from a standpoint of operating cash flow. Now, when you look at it from a standpoint of adjusted operating earnings, it always looks expensive because the market has always priced this at a high valuation. But nevertheless, no real reason to sell Coca-Cola if you're investing in it for the dividend and the cash flow. And then finally, I promised you this. I want to make another point. If you're investing in these stocks and they get very, very expensive, for example, let me go back to this 3M example I showed you earlier here, and just give you some insights into what another reason why you could sell a stock. This would be my final reason. If you've got a better place to go, I'm going to go back to adjusted operating earnings here. And, had you held 3M, and this is December of 2017, even into 2019, anywhere up in these valuation levels would have been a good time to sell. And, you were looking for, you've got an A+ rated company with 57% debt. Well, if I'd have gone in and if I'd have been following and looking around here and I wanted to sell 3M back there, if I'd have looked at a company like Prudential when 3M was very expensive, I could have bought Prudential at very low valuations here, 10 times earnings, another A-rated company with only 20% debt. Now, here's the rub. I wouldn't have made a lot of money on this stock up till now. Okay, that's the risk of selling. But this would have been a place where I'd have been more comfortable and felt that I was taking a lot less risk because I was still moving from a really high quality company into another high quality company at a better valuation and a much better dividend yield. That would be the other thing. So I could be collecting my dividends. Now, eventually, I think this Prudential deal is going to pay off. Okay, I'm willing to be, I did an article or video recently called Intelligent Patience. I'm willing to be patient as long as I believe I'm buying a company that's got good, solid fundamentals and I can hold on it for a long time. So anyway, what's the best time to sell a stock? Probably never if you do your homework and buy the right company. There's a difference between a sell decision and a buy decision. I want to make that clear. I wouldn't be buying Apple today, but if you've owned Apple for the last decade, you still might not want to sell it as long as you're willing to do that final, rule that I say all mountain climbers and all great value investors realize, that the only way to get to the highest ultimate peaks is to be willing to eventually traverse the valleys that will come in between. And that's true. So, buy and hold is an easy decision if you own the right business. Trying to make a sell decision is very, very tricky. I don't know if I've helped you or confused you here, but the point is, if you buy the right companies and look for those forever holdings, the sell decision does become a lot easier. Thanks for watching. If you like this video, give me a like, ring the bell, share it with other people, and do all the nice things that you always do for me. I look forward to talking to you again soon in the next video. And I might be doing some more on the sell decisions here in forthcoming videos because there's actually a lot of ground to cover on the sell decision. It's not an easy decision, probably the hardest decision investors have to make. And therefore, it's one big good reason to not try to make it too often. Buy and hold is a very important strategy that has worked for a long time in the stock market. Thanks for watching.